Why everyone is suddenly so interested in U.S. bond markets. 5 hours ago, Michael Race, economics reporter, BBC News. Share, save. Getty Images. U.S. President Donald Trump during a cabinet meeting at the White House in Washington, D.C., U.S., on Thursday, April 10, 2025. The president is wearing a blue suit and a red tie. He looks on with a furrowed brow. Getty Images. Stock markets around the world have been relatively settled this week after a period of chaos, sparked by U.S. trade tariffs. But investors are still closely watching a part of the market which rarely moves dramatically, the U.S. bond market. Governments sell bonds, essentially an IOU, to raise money for public spending, and in return they pay interest. Recently, in an extremely rare move, the rate the U.S. government had to pay on its bonds rose sharply, while the price of bonds themselves fell. The volatility suggests investors were losing confidence in the world's biggest economy. You may think it's too esoteric to bother you, but here's why it matters and how it may change President Trump's mind on tariffs. What is a government bond? When a government wants to borrow money, it usually does so by selling bonds, known as treasuries, in the U.S., to investors on financial markets. Such payments are made over a number of pre-agreed years before a full and final payment is made when the bond matures, in other words, expires. Investors who buy bonds are mainly made up of financial institutions, ranging from pension funds to central banks like the Bank of England. What is happening with U.S. bonds? Investors buy government bonds because they are seen as a safe place to invest their money. There is little risk a government will not repay the money, especially an economic superpower like the U.S. So when the economy is turbulent and investors want to take money out of volatile stocks and shares markets, they usually place that cash in U.S. bonds. But recently that hasn't happened. Initially, following the so-called Liberation Day tariffs announcement on the 2nd of April when shares fell, investors did appear to flock to U.S. bonds. However, when the first of these tariffs kicked in on the 5th of April and Trump doubled down on his policies that weekend, investors began dumping government bonds, sending the interest rate the U.S. government would have to pay to borrow money up sharply. The so-called yield for U.S. government borrowing over 10 years shot up from 3.9% to 4.5%, while the 30-year yield spiked at almost 5%. Movements of 0.2% in either direction are considered a big deal. Why the dramatic sell-off? In short, the uncertainty over the impact of tariffs on the U.S. economy led to investors no longer seeing government bonds as such a safe bet, so demanded bigger returns to buy them. The higher the perceived risk, the higher the yield investors want to compensate for taking it.